Welcome. It's Tax Tip Tuesday with me, Christine Walters, on June 6th. TFSA versus RRSP, which one to choose? So many people wonder whether to invest in a registered retirement savings plan, the RRSP, or a tax-free savings account. So the two of them will both save you money as well as reduce your overall tax burden, but they do that in very different ways. When you understand how these two accounts or programs work, you can then decide which one is best for you and when to use them together if you desire to. So first up, what is a TFSA? Anyone over the age of 18 or 19, depending on the province of residence, which province you live in, can use the tax-free investment savings account, the TFSA, to save money and hold investments. You can hold EFTs, guaranteed investment certificates, GICs, bonds, stocks, and or cash. All of those things can be saved in a TFSA. In a TFSA, the income that is earned is tax-free. So when you get dividends or interest on your GIC, that's all tax-free. So the interest, stock dividends, capital gains, all of it is tax-free. However, the contributions that you make to your TFSA don't reduce your current taxable income like RRSP contributions do. So the TFSA has an annual contribution limit that's the same for everybody, but the unused contribution room, so if you happen to not use your limit in a given year, that unused contribution room can be carried forward to the lifetime maximum amount, which currently, for somebody who was 18 or 19 in 2009, is $88,000 that you can save tax-free in your tax-free savings account. So in your TFSA, each year there's an allotment of around $6,000. The government adjusts it for inflation every few years. So that means that every year you can put in that annual limit, $6,000, plus any unused amounts from the previous years. So you can find out what your current contribution limit is by visiting your CRA My Account online, or by looking at your current tax returns notice of assessment. Your current year's notice of assessment will have the amount available on it. So TFSAs are tax-free because you contribute to them with your net income. That is your net income, that is your income after paying taxes. So there's no tax break at the time you make the contribution to your TFSA, but when you withdraw the money from your TFSA, you're not liable for any type of taxes, including capital gains tax. So you'll never owe taxes on your earnings or the money that you take out of your TFSA. Now, what is an RRSP? An RRSP, so in the same way as a TFSA, an RRSP allows you to save and invest for the long term, but the RRSP generally allows you to contribute larger amounts of money every year, and it reduces your taxable income accordingly. So it allows you to defer your current taxes, so taxes this year, while you're saving for retirement. So the maximum RRSP contribution limits are, so for 2023, the maximum was 30,780. In 2022, it was just over 29,000. In 2021, it was 27,830. And in 2020, it was just over 27,000. So every person's contribution limit is different. Your contribution limit is calculated every year after you file your taxes. And what it is 18% of your earned income for that year that you're filing the taxes. So this year we're filing 2022 taxes. So the other thing you need to be aware of is that not all types of income count towards your earned income. So the two most common ones are employment income, T4 income, and self-employed income. Some of the other income types do count towards it, but you want to be aware of what does and doesn't count towards it. So again, you can find your current RRSP contribution limit in your CRA account online or on your most recent notice of assessment. So with an RRSP, the money that you withdraw from it will be subject to tax in the year that you make the withdrawal. This is why it's designed for long-term savings. So when you turn 71 and you can no longer contribute to the RSP, that's the age limit where you have to stop contributing the year you turn 71. So at that point, you must either withdraw the full balance and pay the applicable taxes. So that's not too big of a deal if you don't have a very big balance in there. Or you can transfer the balance to a registered retirement income fund, a RIF. So it's an annuity that pays you a set amount every month or every year, depending on how you set it up. So the concept behind investing in an RRSP is that you are supposed to be in a lower tax bracket when you withdraw it at retirement than you were when you earn the income in your 30s, 40s, and 50s. So basically, you will pay less tax overall over your lifetime by contributing to the RRSP. So in addition to that, I guess I should say there's also the deferral of taxes. By pushing taxes paid further down the line, you get the benefit of that tax deferral, that tax savings year over year. So, $25,000 paid 10 years from now is less money than $25,000 paid today. So based on your or a person's individual financial situation and goals, the best investment option for you is something that you need to look at individually and overall. So TFSAs, like I said, require you to pay tax on your income earned before you can make the contributions, while RRSPs require you to pay taxes later on in life. You defer the taxes until you're older. And that's when you withdraw them, when you're older and you withdraw the money, sorry. So in addition to your income, your investment timeline, whether you're saving for the short term or the long term, and other things such as your spending habits, these factors will help you decide on the right investment choice for you at any given point in time. So when you're young, TFSAs might be better. As you get older, it might be more beneficial to switch to RSPs. It's not necessarily a one or the other situation. So that being said, it is possible to use both of the vehicles simultaneously, TFSA and RRSP. So things that you need to consider are, one, looking at your income and your tax bracket. The money that you put into your RSP is tax deductible, so your deductions go towards reducing your current tax liability. If you make less than $50,000 a year, the deduction is less valuable since you aren't likely to owe much in income taxes after you claim the basic credits and whatnot. So in those kinds of cases, you are probably better off putting your money in your TFSA. That being said, there's a little known secret with RSP contributions. You can still contribute to your RSP, but you don't necessarily have to deduct it in the year that you contributed. So if you happen to be in a lower income year, you can defer deducting those contributions on your tax return to next year or 5 years from now or whatever the case may be. So that's an option that if you don't quite understand, I encourage you to reach out to a tax professional to see if that's something that would be beneficial in your particular situation. A second thing to look at is looking at your time horizon. So how long are you planning to invest the money? When do you think you're going to need it? When you withdraw your RSP money, the theory is that you will be earning less money, which will put you in a lower tax bracket. So the RSP program is designed to help you pay less in taxes overall. And while this is effective for its intended long-term purposes, saving for 10, 20, 30 years, it doesn't help you achieve short and medium-term savings goals. So your TFSA is probably a better option for those short to medium-term goals, since the withdrawals are always tax-free and penalty-free. In just a second, I'm going to talk about an exception to that. So number 3, you also want to look at group plans. So with your employer, RSPs and other similar tax deferred accounts like defined contribution pension plans, so employer pension plans, especially if you work for the government, they can be made even more valuable if your employer matches your contribution. So usually employers contributions work something like this. They will match your contribution, sometimes dollar for dollar, sometimes more. I've seen like $2 to $1, sometimes less. They match 50 cents for every dollar that you put in. But basically, they're giving you free money to invest. And if you don't take advantage of it, basically you're making less money than the rest of your coworkers are who are taking advantage of it. So if you have access to a matching program, I highly recommend you take advantage of those free RSP dollars or other pension dollars that are available to you. And then number 4, So this is where the short-term benefit of an RSP can come to your advantage. So you need to look at if you're saving for education or for a first-time home purchase. So eligible home buyers can withdraw up to $35,000 from their RSPs to put towards their first-time home buyer's purchase through the home buyer's plan. So that's a great way to access a large sum of money, such as for your down payment. And while it has to be repaid over the next 15 years after you take it out, that loan is interest free. And then similarly, there's also the lifelong learning program, which allows you to use your RSP savings to pay for full-time education or training up to a $20,000 withdrawal over the course of 2 years. And then that you would repay within 10 years of finishing your school. So on the flip side, there are two avenues where short-term using your RSP can be to your advantage. Put money in for the home buyer's plan or for going to school. You get the tax deduction if you need it, or you can defer the tax deduction, still withdraw the money, use it to buy your first house or go to school. Get the best of both worlds. And then lastly, you want to take a look at your retirement scenario. What do you think that's going to look like? So in TFSAs, like I said a couple of times, the withdrawals are always tax-free, whereas with RRSPs, the withdrawals are always taxable. So retirement should mean that your RSP withdrawals are taxed lower than when you earn the money that you contributed, so that you pay less taxes overall. That may or may not be the case. So then you take advantage of the fact that you deferred the taxes for 5, 10, 15, 20, however many years. And then just as a side tip, if you do happen to get a tax refund and don't have any credit card debt to put it towards, I recommend that you invest it in your TFSA. That's just my personal little tax tip of what to do with it. So if you take these last five factors into account before choosing where to deposit your money in RSP or a TFSA, you should have a better understanding of what's right for your particular situation. And again, if not, if you want to understand the tax implications better, then reach out to a tax professional who can guide you and give you scenario analysis on which one does what for you on the bottom line. And or your financial advisor wherever your investments are held at a bank or other financial institution. So I hope you enjoyed this week's Tax Tips Tuesday with me, Christine, and come back next week for another tip, and enjoy the rest of your week.